in this webinar today. We're talking about real estate investing and mortgage notes. And along with that, I have Brian Martinez along helping me. He's from New View. They are a self-directed IRA company. And the reason why I brought Brian on, he's in the business development part of the company, is to explain how investing in real estate notes can really help your retirement account, either your 401k or other retirement accounts. He can show you ways that self-directed IRA can be used in real estate note investing and the benefits of that. But myself, my name is Gilbert Ross. Name of my company is Abundant Capital Group. I've been in real estate for over 16 years as a real estate agent primarily, and then more recently got into the real estate investing field and the real estate note field. And I just wanted to, share this information with you. It's not something that is widely known, in investing and real estate investing. A lot of people just think about fixing and flipping or buying and holding, but there is another way or something else that can be added to those two things to also increase any type of retirement account, or if you're just looking to, buy an asset for cash flow. So my goal here is just to explain what a real estate note is, what and how you can purchase them. And then I'm going to bring Brian on, and he's going to talk about the IRA or self-directed IRA portion of it. So the first question is obviously, what is a note? A note is one of two primary documents that go into when you purchase a home. When you purchase a home, you have the mortgage document, and that pledges the property. So that basically says that this piece of property that you're buying, if anything happens with this particular loan, the bank or the financial institution can then take back that property to cure any type of deficiency. But then also with that is the promissory note. The promissory note is a legal document that makes a person or entity responsible for the repayment of the loan. It also references the terms of the loan, the interest rate, how many months the payment will be made, the amount of the payment. So these are your two main documents when purchasing a piece of property. And what a lot of people don't know, or maybe you do know, and that you can purchase a promissory note. You can purchase those payments. You can purchase all of the payments, and you can purchase partial of those payments. And this is a great way to, invest in a little bit different way, like I said earlier, from just buying a house to fix it up and flip it. Obviously, you have to get a loan, you have to deal with contractors, you have to deal with a lot of different things when you're doing that to fix the property up. It takes anywhere from 90 days to 180 days or longer to fix up a property, to sell it on the fix and flip side. Or if you have heard about or done buying and renting out, you still, as a landlord, you have to go and collect payments. If anything breaks on the property, if anything happens at the property, you do have a big responsibility to cure any type of issue on that particular property. So with notes, you don't have those same concerns, those same responsibilities as the person who owns the note. So that is, really why, want to bring this out. And again, the purpose of it for you is to grow your retirement account or any type of savings or any type of account where you have some money that is getting low interest and not getting a lot of interest. It's to help that type of account grow more safely and quicker. An example of this is that you purchase a house at $50,000, you have a 7% interest rate at 360 months of payments, and you're paying $332.65 a month on something like that. That's all the information that would be in the promissory notes. So when it comes to promissory notes, They run in pretty much three categories. You have what's called a performing or a reperforming note. You have sub-performing, and then you have non-performing. So kind of to break those three areas down, a performing note means that the homeowner, it has been making the payments 12 out of 12 months for an extended period of time, or within the last 12 months has been making all of the payments. Reperforming means that the property or the person could have not made or missed a payment maybe 2 years ago, 3 years ago, 5 years ago, 10 years ago. They may have missed one or two payments, but for the more recent future, more recent past, I should say, they have started to make their payments every month. So pretty much a performing or reperforming is somebody that it shows a good, strong payment history of making their payment each month. Then you have what's called sub-performing. That means that the owner has made 10 out of 10, 10 out of 12 payments over the last 12 months. So maybe they missed the payment somewhere, down the line, and they made all of the other payments. They missed maybe a one or two. Now, when you talk about non-performing, that means that the person has missed a payment, has missed more than 3 payments consecutively. So now the property is kind of going into a pre-foreclosure status, and eventually, most likely, would go into foreclosure. So those are the 3 areas where notes can be purchased. Obviously, if someone is making their payment, that can bring an investor or a person that is starting to invest in this more security. They feel more confident in purchasing something like that because they know that this person pays every month. They can expect their money each and every month. Or the reperforming, maybe they had a little issue, but for an extended period of time now, they have been making payments. Sub-performing, that may take a little bit more time to kind of get this person on track. Maybe you don't feel as good because they've shown a history of missing, 2 payments. So you may want to be a little bit more cautious with this particular type of investment, but you have received 10 out of 12 payments. So when you look at it from that standpoint, you're still doing good and probably going to end up doing well with that particular investment. The non-performing, you have to prepare yourself to take back the property on this particular type of asset. That means that the person hasn't been paying, and most likely they won't start to pay. But it doesn't mean that necessarily when you buy these. A lot of times when you do invest in these non-performing, because of the discount, and we'll talk about that a little bit later, because of the discount that you purchase these notes at, you have the ability to go back to the homeowner and try to work out or restructure payments, the amount of payments, the number of months that they will have to pay. You have a lot more flexibility as the note owner to go to them and try to work something out. And a lot of times the person that owns the home, for whatever reason, life happens, they most likely can get back on track if you can make it affordable or make the payments more to their liking or something that they can handle at this particular time. And again, because of where you're purchasing this particular asset, you have more flexibility to get a good return on your investment, even though you may restructure things. So, but like I said, we'll talk about, in terms of pricing and things like that later. So why invest in real estate notes? You have the monthly passive income, and this is considered the closest thing to a passive income investment. Like I said, with fix and flip, you really have to be more hands-on in those types of scenarios. You have to, again, follow up with contractors, making sure that you meet with different inspectors that have to come by and make sure that passing code and doing all of those things. Um, and then again, when you're rental properties, you still have to be involved with tenants. You need to go to the property. You need to show up. You need to be a little bit more visible. So it's not as passive as a lot of people you may have heard in the past talk about. But with real estate note investing, really all you do is the money just either goes into your retirement account or self-directed IRA, which we'll talk about later as well, or affectionately known in industry as mailbox money. You really don't have to do anything besides just maybe with a servicing company, making sure that your payments are received and touching base with them and making sure that the payments are coming in every month. So it's the closest thing to a passive income stream. You don't have any type of ownership responsibilities or liabilities, as I mentioned before. If toilets break down, a crack in a pipe or foundation. When those things happen to you as a homeowner or to people that you know, they do not call the financing company that gave them the loan to come out and fix it. And neither will you. They won't call you either. It's up to the homeowner to remedy any of those things and to, take care of the property so they can live the way that they would like to live in those particular properties. And in terms of liabilities, you don't have any liabilities for the property. The only real liability that you would have, again, is just making sure that your payment comes in. So that's, actually, that's really not even a liability. So there's a minimal amount of legal responsibility when it comes to owning notes. Really, the only thing that you would have to do in the case of if someone stopped making payments or anything like that is to foreclose. And then a lot of times you can, not have to go the foreclosure route in these instances because you can reach out to these particular homeowners, find out what their situation is, see if there's something that can be worked out. It's more personable. And a lot of times because they know the situation and you know the situation, they're more willing to work with you to either stay in the property or do what's called a deed in lieu of foreclosure. They'll basically sign the property over to you without having to go all the way through the foreclosure process. But worst case scenario, you would have to take a property into foreclosure, and depending on where you purchase this particular note from, that process can be a short process or it can be an extended process. So those are kind of the legal responsibilities. Again, I talked about low monthly expenses. When you own a cash flowing property or rental property, you have to a lot of times keep up with the utilities, water, taxes, insurance, and other expenses for the property. With notes, you don't have that. Pretty much your only expense is with a servicing company, and servicing company fees, can be less than $100 a month. Maybe some a little bit more than that, but that's kind of gives you an average on what it's going to cost just to service this note. And basically, they make sure that the payments are collected and everything is running smoothly with the property. So you don't have to have some of those other expenses that we talked about with the cash flowing property, and then obviously on the fix and flip property, you have to pay interest on the money that you borrow for this particular investment. You have contractors that need to be paid. So there's a lot of other more expensive monthly expenses when it comes to dealing with fix and flip or rental property. You get positive cash flow. It's very hard not to get positive cash flow with notes because of the expenses that you do pay, excuse me, and the expenses that you don't have to pay. So the positive cash flow is going to be there in that instance, and that's kind of you can understand that very easily based on what you have to pay for a note as opposed to fix and flip or rental property. Also, with notes, you're able to recapitalize. That means I talked about earlier a little bit about buying or selling. In this case, if you're a note owner, you can sell a certain amount of your payments, the payments that you own. If you own 360 payments, you can sell 100 payments. You can sell 50 payments. You can sell 200 payments. And based on what you paid for that particular asset, somebody will pay you for those months that they'd like to pay for you. So you can still get a lump sum of money back off of this note and still own the remaining payments on the back end, or the lump sum of what is owed on that particular note. And then again, if you have some questions about that, we can talk more about that in depth at a later time. But that's a really big positive when it comes to this. So even if, for example, you buy a note for $10,000 and you buy, let's just say, 180 payments, you can sell again, a portion of those payments for 5,000, 6,000, 7,000. So you're able to get that money back, and then you're still able to collect payments once the months that you have sold are finished. Then the remaining amount of payments come back to you. So, I think that's a really big positive when it comes to this type of investment. And then again, all of this money, which Brian will talk about, will be going directly into your IRA. You have a wide range of purchase amounts. You can purchase things for 5,000. You can purchase notes for 50,000, 100,000. So if you're someone that doesn't have the money to get out to purchase a loan, to buy a 2 or 3 family home, or you don't have the type of capital it may take to do a fix and flip investment, you can take smaller amounts of money to invest in notes. You can purchase notes. I've seen people purchase notes for a couple of $1,000s. And then obviously you have people that purchase notes for hundreds of thousands of dollars. So no matter where you are in terms of the amount of money that you have saved up, you do have the ability to purchase a note and then receive monthly payments and get a good return on that money that you're putting out to purchase that note. And then again, as I touched on a little bit earlier, you can buy these at a discount. And that's the big advantage. When you think about notes, is that a lot of people who own notes, because there's so many payments in a note, could be again 180, could be 280, could be 360 months. A lot of times people will take a lump sum today, as opposed to waiting for all of those monthly payments to come over that time period. So that is significant as well. Again, if you created a note for $10,000 over 180 payments, somebody may sell that note for $6,000, $5,000 today, as opposed to waiting 180 months to collect all of those payments. So that is something that is a real positive about this as well. You definitely are purchasing these notes at a discount, and it's a discount based on the market value and the outstanding balance that's owed on the note. So those are the two things that you really have to look at when purchasing it. So this right here will show you that for performing and reperforming notes, since the person is making payments, as we talked about earlier, or has gotten back on a good track of making payments, you're not going to get as big a discount that you would for other types of notes, just because you can expect you have a high probability of receiving payments each and every month. So someone is not, may not discount that as much. Not to say that they won't, depending on that person, the person that's selling, their circumstances, but typically you're probably looking at anywhere from 90 to 95% of the outstanding balance and the market value for that particular note. Yes, the subperforming, you can look at a discount of about 80% of market value. If you can find them in that area, or obviously less, then that's a pretty good deal. That's, these are kind of just standard industry standards for this. So you can expect to pay about 80 cents on the dollar for a note that is classified as subperforming. And then you have the non-performing, and this is where you get your biggest discounts, obviously, because the person has shown to, not be paying or stop paying at this particular point. So you can get these at greater discounts, and because of the amount where you're getting these discounts, again, you can go to the seller. I mean, well, not the seller, excuse me, the homeowner, and try to work something out with them because of where you're able to purchase this note at. So this last slide here, or the last couple of slides, is just a case study. This particular property was in Illinois. It was purchased for $23,000. It needed, maybe some paint, some carpet, some minor repair, somewhere between $5,000 to $8,000. And then what happens is that you're able to get this type of note, and since you own it, you can offer someone you can be the bank on this particular property where they can make payments to you. And what happens on this is that the market value for the property was about $35,000, maybe $40,000 at most. But you're able to structure a deal with the seller to purchase this property at $55,000. So again, with notes, a lot of flexibility, a lot of different creative financing techniques that you can do to maximize the asset, the value of an asset. And again, this is all money and payments that'll be going into an IRA or some type of retirement account that you have set up, and that's really the purpose of this webinar, is to show you that there are certain assets out there that can be purchased for relatively cheap when you talk about real estate, and you can do it throughout all states. You don't have to just stay in the state that you live in. Obviously, if you do want to do that, you're more than willing to do that, but you can do this throughout the U.S. and purchase properties all over. And again, you're able to structure this to sell it for $55,000 with terms. Again, you can see the repairs there, what the legal cost was, property taxes, and again, like people told us, it was about $35,000, but we were able to structure this with a buyer to buy this at $55,000. And then two, what happens in this scenario is that, as you can see, it's 10% interest, which some people may see as high. What will happen is that this particular owner, what they'll do is probably after 12 months, 24 months, they'll probably refinance. They'll refinance with the bank. And then when they do refinance, this total of $55,000 or whatever the outstanding balance at the time of them purchasing is going to have to be paid off, and you as the note holder are going to receive those 2 years or 3 years of payments that they made before they got refinanced, plus a lump sum. So you can see what your initial investment is. I think it was somewhere around $33,000. You're probably going to make somewhere above between $55,000 to $60,000 once the person refinances, probably gets themselves a lower interest rate, and you as the note holder, will get that lump sum. So as you can see, the returns are tremendous. Again, all this would go into your retirement account, a 401k account. And, obviously you can see the benefits of this. Hopefully, this is something that you would want to do. But at this time, I'm going to bring Brian Martinez on the line. He's going to talk about the IRA side of things, and self-directed IRA. He knows a ton about it, and he'll give you more information on that. With that being said, Brian, are you there?
Yes, Gilbert, thanks for inviting me over for this webinar. I am more than happy to go through some of the information when it comes to using a self-directed IRA. So this is just a disclaimer, NuView being a self-directed IRA, what gives us the ability to allow people to make alternative assets, just like doing notes with their retirement accounts, is the fact that we have to remain non-fiduciary, which means that we can't advise anyone on any specific types of investments. They would come to us and let us know what type of investment they're looking to do, and we would review the documents. So we're not responsible for any type of investing. We are not financial advisors, but we do give you the ability to make alternative investments that aren't normally like the stock market or mutual funds, things that you would do with like a TD Ameritrade or a Schwab. Those type of companies are designed for the stock market. Our type of company is designed for you to have more control over your retirement money and make investments that are alternative, like real estate, like notes, like precious metals, things like that. And I'll go into more depth on the types of things you can do with a self-directed IRA. So NuView, we've been around since 2003. We own about 1.2 billion in client assets. The things that we like to build our business on is the fact that we are simple to do business with. We are available, we're responsive, and we are able to build a relationship with you. A lot of companies aren't able to do that because they're large companies. You speak to an 800 number and you're always speaking to a different person. Well, here at NuView, the great part about that is the fact that we are going to answer the phones every time you call. We're going to answer an email, and we are able to just be available for you. And you're going to talk to the same people every time you do get to speak with someone. We actually have about 45 people that are employed with NuView right now. We hold 1.2 billion in assets for our clients, and majority of our clients do something within the real estate realm. So the biggest motto when it comes to building wealth is that you have to save your money. There's no secret. It's just about starting to save and starting to save while you're young so that you can retire wealthy, and everyone wants to be able to retire wealthy. So this is just some statistics on average how many people actually have a retirement savings account. And as you can see, the older you get, there's a percentage, about 15.4% that are ready to retire, do not have any type of retirement account. And it's actually, the numbers are increasing. So it's definitely something to be aware of. So the difference between what we do and you going to a Schwab or a Fidelity or a Merrill Lynch is they actually get 8% of what the return is that you invest, versus with NuView, we have our normal banking fees that we charge. We don't charge any more, we don't charge any less, and we're very black and white when it comes to fees, and we'll go through the fees again at the end. Okay, so why don't advisors recommend self-directed IRAs? There's a few reasons. They require a custodian, so another company that they're not working for, like NuView. It is a one-off process, so they pick one specific type of investment they want to go into, and it's not as easy. It's a little more paperwork and a little more complicated because you're doing the paperwork yourself and you don't need a financial advisor to do it, versus just picking some stocks is what a financial advisor would do. Not only that, there's one main reason why a financial advisor would never recommend for you to do a self-directed IRA, and that's because they don't earn commission off self-directed IRAs. Why would you want somebody else to be able to make commission off of your investments? That's the biggest question I ask my clients. So this is just an example of why saving is so important. So this example is doubling $1 20 times, and you end up, if it's taxed at 25%, you end up with $72,000. It's pretty good, right? I bet you can do a lot better. Let me tell you how you can do a lot better. When you're investing your retirement account, it's either going to be tax deferred or tax free. So let me show you the biggest difference. You double that same dollar 20 times and it's tax free, which is something you can do with a Roth IRA. You're going to end up with $1 million. Huge difference on what you can save and how much more you can earn using a tax free account, correct? All right, so these are the types of accounts that you're able to use to self-direct an IRA. The most common is traditional IRA. About 90% of the population has either a 401k, which is a pre-tax dollar, or a traditional IRA. Then you have your Roth IRA. That's going to be a post-tax account. So with the Roth, the way it works is you pay your taxes going in, and then all your capital gains off your investments are tax-free. There's a lot of power with a Roth. It's definitely something everyone should have and you should look into. Definitely discuss with your financial advisor and make sure you're even qualified to do that. Then you have a SEP IRA. That's great for, it's like a self-employed pension plan. You have a simple IRA, which is good for small businesses. Did you know that you can actually self-direct a health savings account as well? Then you have your education savings account, which applies for children as well as your grandchildren. And health savings account and the HSA, you can use those to partner on bigger investments like doing a big note. You can have multiple types of accounts, like a joint venture, all partner together on one type of investment, and then they go back into your retirement account, your health savings account, your education savings account. So that's a lot. It's a lot of power and a lot more buying power the more types of accounts you're able to open, and the tax benefits that come along with that. Then you also have a solo 401k. That one is only if you're self-employed. So that's another plan, whole nother presentation. But if you want details on that, feel free to reach out to me. There's a lot that goes into a solo 401k and a lot of power. It's very similar to having like the power of a Roth as well as power of a solo 401 or a 401k plan. That is the only type of 401k that you can self-direct, not a normal 401k. But a normal 401k you can roll into a traditional IRA because it's pre-tax dollars as well. So these are some of the most common types of investments that we see. Real estate is probably the biggest. About 80% of our clients do something within real estate. You have mortgages and notes, precious metals. You can invest in LLCs, debentures, partnerships, and private stock. So even though self-directed IRAs aren't meant for the stock market, you can still do private stock, which is a little bit different because it's not public stocks. And that's usually like shares of a bigger company or something like that you'll see. So there are some rules when it comes to a self-directed IRA. There's a few things you cannot do with your IRA. You cannot purchase life insurance. You cannot purchase any collectibles. And you can't deal with any disqualified parties. So the disqualified parties would be yourself, your spouse, your parents and grandparents, children and grandchildren. So these parties, you cannot do business with your IRA, and they cannot, say you had a rental property, they can never reside on that property. They also cannot put sweat equity. So they basically can't receive any benefits from you making an investment with your IRA. So you couldn't invest in, say, your wife's company. You couldn't do that. That's just an easy example to go by. So you want to avoid competing with traditional types of investments, and the best way to do that would be alternative investing, like doing tax lien deeds, non-performing notes, real estate, structured settlements, private stock, and startup companies. These are all ways that you don't have to worry about competing with the stock market. So this is what it costs to open a self-directed IRA. And like I said, we charge normal banking fees. It's only $50, which will be waived if you mention this webinar, and that's for your application. It's $95 when you identify the type of investment you're doing and we file that for you. So anytime you make the purchase or sale of an investment, it's a $95 transaction fee. And then typically the most common annual fee that you'll see, it's $295 once a year that you pay for us to do IRS reporting for you. And I can get into more depth on what types of tax forms that we do. If you do have any questions, you can feel free to reach me. You can go to our website, newviewtrust.com, or you can call our 800 number, ask for Brian in business development, and I would be more than happy to answer any questions that you have. Gilbert, thank you so much for having me. It was great being able to share this information. And if you need anything at all, feel free to reach out to me or Gilbert. Thank you.